Right now, how do we handle sales transactions for a perpetual inventory system? Now, as was discussed in the other video, again, periodic versus perpetual inventory, like what's the upside of the periodic system? Well, the periodic system's upside is there's less accounting for your merchandise. So in other words, there's not that many transactions you have to book. So, but of course, what do you lose? You lose you lose, information value because of that. You don't know what your inventory is at one point in time. So again, what's the good thing about this system, perpetual system, is we know what's going on with our inventory and what our cost of goods sold is. So what's the downside of it? What's the drawback? The drawback is here. Every sale is going to generate 2 transactions. So that's the downside. There's more record keeping that you have to do because you're using a perpetual system. Because what are the 2 things that are happening here? There's the sale itself. The other is the cost of the sale. So in other words, the minimum number of lines for any transaction in the selling function is going to be 4. That's what you're going to look at. But I group it as 2 separate transactions. I don't just group it as like a 4-line entry, but it's ultimately 4 lines. And so here's the basic example that we're going to build on top of. So we're going to start on November 10th. Buying at wholesalers is going to sell $25,000 in merchandise on account to one of its valued customers, Burroughs Retail, and Vonnegut determines cost of goods sold as to be $10,000. So our key numbers here, of course, are the amount of the sale, 25, and what was the cost of sale was 10. Okay, so that transaction that's generated as a result of that on November 10th would look like so. So again, that's the sale itself, accounts receivable debit, sales credit for the $25,000, and then the cost of the sale. In other words, we have to say now we have an expense, $10,000 from doing business because these goods are no longer on hand. So debit that expense account, cost of goods sold, and then credit inventory for $10,000. Again, that's just your basic run-of-the-mill, straightforward example of this type of transaction. Right, of course, we're going to add some complicating factors here because we talked about in the previous video, we talked about the concept of the sales discount. So we're going to look into that. So in other words, we want to incentivize this customer, in this case, Burroughs Retail. We want to get them to pay faster than our net period. So we're going to just look at the 2 basic elements of this sale. We can be a third element that we'll talk about later, but just this is what we need for now. So again, this is dealing with sales discounts, terms of sale. So this is what we're going to tell our customer when we sold them the goods. We'll tell them 210, so 2/10, comma, N/30. So what's that shorthand when you unravel it mean? In other words, how do you interpret that? So the 2% is the amount of the discount. So if they get a 2% discount, if they pay within 10 days, comma, otherwise, we expect them to pay the net in 30 days. So just some of the ideas here. Again, so first of all, again, when does the net period begin? The net period begins, in this case we call it the credit period, begins basically on the date of the invoice. In other words, when we said the transaction culminated, which in this case would be November 10th, that's when all that begins. So in other words, they had from 10 days from that date to pay within the discount period. So in other words, we expect to be paid no later than November 20th in order to apply that 2% discount. Otherwise, they owe us the net amount due, which we put that on December 10th. Would be 30 days from November 10th. Now, just a little bit about enforcement of discount periods. How do you do that? Okay, so what if somebody pays you a day after the discount period? Now, again, in practice, you might still give them the discount. Just so you know, it's your business, assuming you have that latitude, go ahead and apply it. In other words, you don't have to be that rigorous about it. It can be a guideline in practice. Some businesses might be like if they pay us any time before the net period, the 28th day of the 30-day period, here, take 2% off. Thank you for paying early. It's up to you. But as far as how it's going to be enforced in terms of exercises and problems in an academic setting, it's absolute. Right? So if you see that they paid on the 21st, no discount is applied. But just letting you know, again, it doesn't have to be that rigorous in practice, though. All right, so how's the payment going to look if they pay on the 20th? So they paid on November 20th on the full 25. Next slide right here. So it would look just like this right here. So on that date, okay, so let's just go over this. So again, the amount they owed was $25,000. So we're going to take off 2% of that. So 2% of that would give you $500. Again, we're going to track those discounts. We have an account for that. So that's where your sales discounts account comes into play. Again, that's your contra revenue account. So we're going to take that 2% or $500 and we're going to book it there as a debit, which means our customer owes us $25,000 minus the $500 is where we're getting the amount of cash that we will accept in full satisfaction of that AR balance. So that's where we'll take $24,500 and call it even. So in other words, we're willing to take that amount off because we want them to pay us faster. So we don't mind that we lost 2% of that, that sale in terms of giving them discount. They paid us in 10 days. Like, great. We have access to that cash. In other words, that's what we're willing to sacrifice to make the customer, incentivize the customer, not really making them do anything, incentivizing them to pay faster. All right, so we'll add another complicating factor here. And usually the way that we time it is, it happens before the payment within the discount period. So that's really the only way you have to be able to tackle this. So let's say Burroughs decides to return $5,000 worth of goods on the 15th before paying on the 20th. Now this $5,000 is what we, Vonnegut, charged our customer Burroughs for the goods. That's what we're saying there. This is not saying that we paid that for the goods. Again, this is going to necessitate booking something to sales, returns, and allowances. Now, of course, again, we're getting something back. So the concept here is we get something back, we're going to have to restore that to our merchandise inventory, our inventory account. So we have to determine what's the cost of the goods to us. That is, Vonnegut, what did we pay for them and restoring their inventory? So in this case, they determined it to be $2,000. All right, so here's booking the return. Again, this is going to be a 4-line transaction because why? We have the return itself. So that's where you're going to book sales, returns, and allowances debit, accounts receivable credit for the $5,000. And then, of course, we have the restoring those goods to inventory. So what you'll look at is that's the same two accounts that were used in determining, like when we had the cost of goods sold, right? So in other words, what happened on the previous slide here. So again, it's the same two accounts right there. We're just inverting, flip-flopping the usage. So now we're saying we got back $2,000 of inventory because it was returned to us, and we're taking it out of the expense account because it's no longer an expense anymore. We got it back, right? So that's a fair assessment there. And again, the idea here is we got back the goods that we could still sell. They were still viable and could still be sold. That's an important point. We'll get to that in a moment. All right, so what has changed now about your customer? Well, they owed you $25,000, so now it's minus the $5,000, so that means they only owe you $20,000. That's important because when you apply the discount, it's only going to be applied on the outstanding balance. We're not going to give them 2% off of the full $25,000 because they didn't keep $25,000, which is fair enough, right? So it's going to be 2% of $20,000, so that's why the sales discount will be reduced to only $400, right, instead of $500. So it's going to be $20,000 minus minus the $400, excuse me, equals $19,600. We'll accept as full payment in the remaining balance of $20,000. And just to go back to the concept of the pay the net amount and due within 30 days. Net, of course, means net of any sales, returns, and allowances. That's the silent portion there. Now, of course, some other background information that's going to happen here. So when we were booking this return here, we also issued something called a credit memo because you'll notice what? We're crediting the accounts receivable for $5,000. So that's all we're saying by credit memo. We're crediting the accounts receivable we have on the books for you, $5,000. Now we'll come back to why you want to share this information when we talk about purchases. Again, that'll be the next video. So I'll refer back to this by possibly putting this slide back up just so you can revisit it. All right, so we have the information being exchanged, and again, the initial concept here was that this was viable goods that you could still sell. What if the goods were returned and you determined that they were non-viable, you're not going to be able to sell them to anybody, and you also don't have any option of returning them to the company, the business that manufactured them, let's say, and get your money back there? Then how does the entry change? It changes like so. So then now we would have just this basic 2 lines there. That's it. Just sales, returns, and allowances, debit, accounts receivable, credit. Yes, you would still issue a credit memo. That's still true. Now, this is the form that you would use if instead of a return you had what we simply call an allowance, which is a reduction in the price of goods sold. That's all it is. In other words, this is how it usually happens: is a sale culminates. Let's say there's something damaged, and as a rule, sellers don't want anything back. No, keep it. What do I have to give you back to keep everything, if that's possible? And they say, well, and so amount, and we'll keep everything. And usually the example I refer to here is the one that's very common. You may have even encountered it. Let's say you get a piece of furniture, and what happens often in furniture being delivered is it gets dinged up. Happens all the time. There's no person in the furniture business that wants anything back that's damaged. Harder to sell. You got to sell at a reduced price. It's just a pain. So usually they go, okay, it was dinged a little bit. What do you need to keep it? They look at their numbers, and then the negotiation begins, and maybe you get the customer to settle on $500. So you just say, great, they take $500 off, but they keep everything. So that's all an allowance means. It's meaning you're allowing some of the money to be refunded to the customer, but you get nothing back. So that's why you only need 2 lines, because there's nothing being restored to inventory. All right, so just the last piece here for completeness sake is what if Burroughs doesn't pay until the net period, which is December 10th in this case. So it would just be like any other payment on account receivable. So just cash debit, account receivable credit for the full $20,000. No discount would be applied. Right, and that concludes the selling material. Again, you might see some of this back in the purchase material, and maybe some of the other videos as well, just for contrast, just to underscore some of the other concepts. So that's all for now.